Hello and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
All right, let's dive straight into Baytex Energy Corp. Because, well, the corporate restructuring has led to this really intense market consolidation we've seen. I mean, specifically, right now in mid-December 2025, the stock has been locked tight. It's just bouncing between $3 and, say, $3.20. That's about $4.20 to $4.50. And this is really the market just trying to figure out what to do with the new BTE. This action is the market digesting the company's transformation from this sprawling, diversified conglomerate back into a pure-play Canadian heavy oil producer. This all follows the announced $2.3 billion sale of its main U.S. asset, the Eagle Ford. Now, what makes this so fascinating isn't just the price, it's the trading structure itself. We saw enormous daily short volume, something like 7.4 million shares on December 16th, and an off-exchange trading ratio nearing 60%.
So, our whole debate today really rests on this shift. Does this sale definitively solve BTE's historical valuation problem and, guarantee a swift re-rating toward the 5 to 7 times EV/EBITDA multiples its peers get? Or does the complexity in that trading volume and the company's frankly checkered past justify this deep valuation discount, which is sitting at just 2.2x to 2.5x? My position is pretty clear. The fundamentals now mandate a swift re-rating. The company has removed existential risk and has generated overwhelming cash clarity.
And I take a fundamentally different view on that response. I mean, I agree the balance sheet cleanup is transformative, of course, but I believe the current valuation discount is warranted. The structural friction we're seeing, that high volume crossing off exchange, and the deep deficits of historical investor trust, they justify the continued skepticism. The market isn't just being slow here. It is actively demanding proven, stable execution before it's going to award any kind of premium.
Okay, but let's just establish the irrefutable facts here. The facts created by this transaction that make the current stock price, well, almost an absurdity. The re-rating is, I think, inevitable because of the sheer magnitude of the risk removal. Just consider the valuation floor that was set by the Eagle Ford sale. The company sold that asset for $2.3 billion in cash. Now, at the time of that announcement, BTE's entire market capitalization was roughly $2.5 billion. Just think about that staggering disconnect for a second. The market essentially valued every single other asset the company owns, the massive heavy oil assets in Peace River, Peavine, Lloydminster, at zero. This fundamental valuation gap is simply unsustainable when you look at the free cash flow.
Get that. But the market also prices in management risk and historical reliability. I'm focusing on the math because the math here is overwhelming. The company is guiding for $400 million in free cash flow, which for listeners is just the raw cash generated after capital expenditures. And on a $2.5 billion market cap, that delivers an FCF yield of approximately 16%. The average yield for its Canadian peers is between 8 and 10%. Why should BTE trade at half the valuation of its comparable companies? And beyond that valuation, the sale solves the primary bear case, the debt wall. The cash facilitates a massive debt tender offer for its 2032 senior notes, moving the company to a net cash position of about $1.28 billion after closing. The fear of insolvency is it's gone, completely extinguished. The risk profile has shifted from a high-risk turnaround to a stable value generator. I see why you think the mathematics dictate an immediate re-rating. I really do. But let me introduce the psychological and historical factors that justify the discount. That 16% FCF yield is certainly enticing, but the market applies this discount because of management's track record of strategic inconsistency. We just can't ignore the recent past. They acquired Ranger Oil in 2023, framing it as crucial diversification into U.S. light oil. Less than 2 years later, they completely reversed course, selling it all off to simplify. That rapid flip-flop, well, it undermines the stability you need for a premium valuation, and it creates this profound guidance fatigue among long-term investors. And the market microstructure you mentioned, it confirms the skepticism. That 60% high dark pool ratio isn't just volume, It's a signal of mandated institutional rotation. When we talk about dark pools, we mean these off-exchange trading venues where large institutional blocks can be crossed without immediately hitting the lit exchange price. These high ratios mean major players, specifically funds mandated to hold U.S. diversified E&P, are fleeing the stock because BTE is no longer diversified. That volume represents a sophisticated, managed institutional exit from the prior investment thesis. And that lack of conviction, it completely offsets the attractive FCF numbers.
Wait, hold on. I think we're misinterpreting that flow entirely. While I acknowledge the institutional rotation part, to interpret 7.4 million shares of high off-exchange volume as instability or some directional lack of conviction is highly misleading. We have to differentiate between structural volume and bearish volume. If this was a mass exit driven by fear, we would see two things: massive volatility on the lit exchanges, which we haven't seen, and a high directional short interest. We have neither. Open short interest has stayed low, ranging from about 2.64% to 3.25%, and the days to cover ratio is tiny, just 1.3 to 1.4 days. So that pretty much throws the whole short squeeze idea or a massive directional bearish bet right out the window.
But the fact remains that sophisticated capital is leaving. Even if they're crossing blocks efficiently in the dark pool, it means that the new pure play Canada thesis isn't immediately capturing the confidence of the very funds that were major holders under the old strategy. The turnover itself is the risk. It introduces volatility and friction.
That's an interesting point, though. I would frame it differently. I believe the high volume is completely explicable through three non-bearish structural mechanisms. It's reflecting a changing of the guard rather than a flight of confidence. First, the institutional block rotation you mentioned. Yes, U.S. mandates are leaving, but the dark pool is simultaneously facilitating Canadian value funds or energy-focused mandates that are entering the name, attracted by the newfound stability and that FCF yield. Second, capital structure arbitrage. Baytex launched a tender offer for the 2032 senior notes right alongside the sale to eliminate debt. Arbitrage funds, well, they often trade the debt and equity simultaneously to lock in small, predictable profits. They hedge their positions by shorting the equity leg of the trade off exchange. This arbitrage mechanism mechanically drives up short volume, even if the funds are directionally neutral on the stock price. It's a technical byproduct of the debt cleanup, not some kind of market prediction.
I understand the technical explanation of arbitrage, but the complexity of needing such sophisticated trading mechanisms just to stabilize the price while major holders flee, it just underscores the underlying instability. Why should investors reward management with a premium valuation when they have only just stabilized the ship after a decade of dilution?
We have to give the current management credit where it's due, especially when we talk about respecting the capital structure and addressing that historical dilution issue. We often forget the critical crisis moment during the 2020 COVID oil collapse. BTE's stock fell below the NYSE's minimum $1 requirement. Now, the standard corporate playbook there is the dreaded reverse split, a tactic that, inflicts severe psychological damage on shareholders and just artificially inflates the stock price. Baytex management explicitly chose to accept a temporary delisting, moving to the less liquid OTC markets, rather than forcing that reverse split. They called this choice honor over engineering, allowing the share price to recover organically, which it did, leading to a successful relisting in 2023. That commitment to preserving the integrity of the share count, even when facing a near-death experience, should be factored into the re-rating process. And now, the commitment to an NCIB, a share buyback program funded directly by the sale proceeds, is the first major effort to actively reverse the decade-long dilution. I'm sorry, I'm just not convinced that a single act of prudence in 2020 erases a decade of pain. Let me tell you why that historical debt of trust persists. Avoiding a reverse split 3 years ago doesn't fix the core structural issue: dilution. The share count ballooned from about 112 million units in 2010 to a staggering 808 million shares by 2024. That is a 7-fold expansion over 14 years. That is the historical headwind that crushes per-share value growth, and it explains why the retail community harbors such deep guidance fatigue and skepticism toward any new strategic promise.
I'm sorry, I'm just not convinced that a single act of prudence in 2020 erases a decade of pain. Let me tell you why that historical debt of trust persists. Avoiding a reverse split 3 years ago doesn't fix the core structural issue, and we circle right back to the strategic instability. The rapid acquisition and sale of Ranger Oil, what investors rightfully call the flip-flop, it shows that management had no clear sustained vision until they were forced by market pressures to simplify. Investors are hesitant to award a pure premium until management proves strategic continuity after the sale. They've successfully executed the balance sheet cleanup, which is massive, yes, but they now must operate as a stable, focused Canadian producer for a sustained period, not just a few months.
I agree, the dilution history is a significant hurdle, but that is precisely why the current market price is an anomaly. The pricing just hasn't caught up to the definitive change in the structural reality.
If we look at the core by thesis, the boomer value fixation driven by that 16% free cash flow yield, it is logically sound, and mathematically, I think inevitable. If we look at the charts, the technical analysis supports an imminent upward move. The stock has formed a golden cross, the 20-day simple moving average crossing above the 60-day, which signals a strong bullish midterm trend. The price consolidation we're seeing between $3 and $3.20 is a textbook flag pattern, just awaiting the catalyst confirmation, which is the official transaction closing scheduled for December 19th. Breaking resistance at $3.36 and then $3.48 will confirm that the market is finally actively pricing in the NCIB, the share buyback, and the resulting increase in cash flow per share. There is simply no fundamental justification for BTE to trade at 2.2x to 2.5x EV/EBITDA when its closest Canadian peers are at 5 to 7 times. The risk premium is gone. The valuation gap has to close.
That's a compelling argument based on pure fundamental and technical indicators. But have you considered why the market forces the show me phase? Investors who endured that decade of dilution and the Ranger flip-flop will not immediately award a 5x multiple the moment the cash hits the balance sheet. They need to see the execution of the NCIB, not just the promise of it. Furthermore, the new pure play Canada focus, while simple, introduces specific operational risks that might justify a slightly lower multiple compared to diversified peers. The company now has increased exposure to Western Canadian Select differentials against WTI. WCS is the heavy oil benchmark, and when those differentials widen, meaning heavy oil sells for a deeper discount to U.S. crude, it compresses margins. Now, the company uses hedging to mitigate this, sure, but it is a specific single-point risk that diversified producers don't face to the same extent. The valuation gap will close, but the full re-rating depends on the successful execution of the buyback and a meaningful, demonstrable decrease in that 808 million share count. Until then, skepticism remains a prudent default position.
The prudence you're championing today is precisely why BT offers such a profound, deep value proposition for those looking past the historical noise. The decisive restructuring has fundamentally eliminated insolvency risk, delivered a massive net cash position of $1.28 billion post-sale, and established a clear, double-digit free cash flow yield that provides a concrete gravitational pull toward the peer average valuation. The mechanics for the re-rating are perfectly aligned. It's simply a matter of the market adjusting to the new undeniable reality.
I concur that the transformation is complete and the fundamentals are now attractive. But the market's current consolidation phase and the visible high institutional turnover reflect a healthy, justifiable skepticism rooted in the company's historical actions and the absolute necessity for demonstrated stability going forward. The valuation gap must close eventually, but it will do so only when BTE successfully uses this cash windfall to prove long-term strategic stability and, crucially, reverses that multi-year dilution trend. The market is waiting for the execution, not just the announcement of potential.
If you enjoyed this video, subscribe to the Stock Market Palantir channel for more stock reviews like this. Thanks for watching, and see you next video.